Hi, everyone, and thank you for joining us today. My name's Joe Stidle, and I'm a member of our client strategies team at Research Affiliates. It's my pleasure to host today's webinar, What Matters in Multi-Factor Investing. This is the first in a series of 5 webinars we plan to conduct over the next 6 months. In this series, we'll explore a broad array of topics. Today's webinar, we're going to start with what matters in factor investing, and followed by the ignored risks of multi-factor investing. The third and fourth webinar focus on the most important issues around portfolio construction. And last but not least, we'll look at integrating ESG considerations. For those of you who don't currently receive our research and would like to, you can register via our website at researchaffiliates.com. Or alternatively, if you prefer, you can follow us on Twitter or LinkedIn. To help us along our journey today, I'm pleased to have Dr. Vitaly Kolesnik, who's head of our Europe research based here in London. Over the years, Vitaly has done extensive research on factor investing, and you'll recognize his name on almost all of the research publications. We really do hope you find this webinar engaging and informative. We plan to roughly have it last about 25 to 30 minutes for each of the webinars in this series. So with that, I'd like to turn it over to Vitaly.
Thank you, Joe. And today's webinar is titled What Matters in Multi-Factor Investing. And the goal of the webinar is to build a framework and to go over some of the facts and some of the research around the topic. And hopefully by the end of this today's webinar, you will have a clearer picture about first the research underpinnings in the space, and then what to look for big picture, in terms of big picture. So now, first let me start by laying a few facts. So smart beta or fact investing is becoming popular. You hear about it in the press, and on this slide I'm showing the number of funds and the AUM growth over the recent decade, even more so. And you can see that there is quite a strong pickup in assets, and there is healthy number of funds lodged each year. And what we want to argue is this is not a fad. There are solid underpinnings, there are solid business reasons why we see this big proliferation of smart beta in fact investing funds. And these are the greater transparency, lower costs, both transaction cost and management fees, and then finally exposure to well understood and explored drivers of returns.
Yeah, and I completely agree with that, Vitaly. In fact, it's the same in the institutional landscape. When looking at the latest FTSE Russell Smart Beta survey, it shows that over 48% of investors now have allocation to Smart Beta within their portfolios. And actually, there's quite a bit of a skew towards European investors, with more than 60% of them having already allocated in the space. And I think a lot of the reasons for that institutional investors really like Smart Beta is that it helps to provide them a more cost-effective alternative to traditional investments. And it also gives them a lot of transparency and helps with lowering the governance requirements.
Yes, I agree with that, Joe. Today we'll walk through some of these elements, and just again for the introduction, I want to show that today what we'll cover today and in the future webinars of this series is based on a lot of research that we have done at Research Affiliates. We view it as our mission to learn for ourselves, to study the subject matter, and then we don't keep it to ourselves. We publish our work, so please follow our research or watch our webinars, which is a condensed version of a lot of our research. And so now let's jump into some of the academic research and hopefully by the end of this section, you will agree with me that there are solid business reasons for the popularity of smart beta or factor investing funds. And to start, let me start with just two pieces of research. The first one is Mark Carhart's 1997 article where he studied the differences in performance between different mutual funds. This is a very classical paper, and what he found was that most of the differences in mutual fund performance are explained by three factors. And the factors are factor exposure, transaction costs, and management fees. So controlling for these three, it's really hard to see persistence in manager performance. Then outside of this, actually now turning to the investor side, there is quite a bit of literature documenting a strong gap between the dollar-weighted and time-weighted return for investors. So what that means is that investor outcome is very different from what investor would have gotten if investor were to do just buy and hold investing. And specifically, the investor outcome is about 200 basis points per annum lower than if they were just doing buy and hold investing. And that's significant. Why are they losing so much? A lot of it is due to rotation between funds and poor timing. And now, just jumping to the next slide. So these two pieces of research then underpin the key features that make factor investing a strong business proposition. And these are exposure to robust factors, low transaction costs, and low management fees. That's what we've seen in Carhart's research. And then simplicity and transparency are very important for investors not to fall trap to this vicious cycle of rotating between funds and losing a lot through that process. So if we could close that gap between dollar-weighted return and time-weighted investor outcome, so investor outcome buy and hold return, that would be a significant improvement for the investor, and simplicity and transparency play a big role here.
And in fact, for those investors that are really interested to learn a little bit more about, this return gap that happens, there's a recent research paper that we just published called "The Biggest Failure in Our Industry," that was written by John West and Jason Su. And I would encourage everyone to go look for that and have a read through it. It's really interesting.
Yes, I totally agree. And so now let me jump and go through these elements one by one. So first one, fees. On this slide, we've looked at the distribution of fees across mutual funds. This is done in the U.S., in U.S. universal mutual funds, and in the Morningstar data, funds are labeled as active, passive, or smart beta. They don't use a smart beta label, but essentially it's the label that they use denotes the smart beta funds. And what you see in terms of fees, active funds, not surprisingly, are high fee products. On average, your majority of the funds charge between 75 and 125 basis points. When you look at passive funds, majority of funds have fees below 25 basis points and vast majority below 50 basis points. So there is quite a big gap in terms of fees between passive and active funds. And then when you look at smart beta funds, now you look at a very interesting shape. The left three columns look almost the same in terms of scale as the passive funds. You have a lot of funds below 25 basis points and vast majority below 50 basis points. Then you have this second hump, kind of what scientists would call probably bimodal distribution, where there is quite a bit of funds hovering around 125, 150 basis points. And what these funds are, these are not smart beta funds. These are smart beta wannabes. And investors would be quite well advised at not take the label at its face value and look under the hood and examine what kind of fees they're actually being charged, and make sure that they're not getting charged high fees. Smart betas deserve passive-like fees. Next, let's look at the transaction costs. Transaction costs is very frequently underappreciated in terms of smart beta funds, and because or generally in passive investing, because generally implementers deliver the index performance. Well, there is a rub here, where there is a lot of hidden costs already built into the index performance itself. So when implementers trade into the close, when the index is being rebalanced, they already produce the market price impact, and that is already reflected in the index performance itself. So when we did a very simple exercise. We selected a number of smart beta funds out there, and they all publish methodologies. And so what we were able to do is take these methodologies and replicate these indices. And then we took a garden variety transaction cost model. In fact, our results are quite robust to the model that we use. And we estimated the amount of transaction costs coming only from the impact on prices from trading, assuming $10 billion managed under each index. And now what you see is the median fund have transaction costs on the order of 15 to 35 basis points. That's pretty material. That's on order, maybe even often larger than the fees charged by many of these indices. But what is significantly worse, is that there are some outliers. And some of these funds, there are 4 funds with transaction costs above 100 basis points. Well, even backtested alpha is not going to be as large in many of these cases. So right off the bat, you know that when these indices will start attracting flows, the transaction cost will kill all the potential benefit from these funds. And so transaction costs are just very important, and the magnitude can be very large. And so what can investor watch out for in terms of characteristics for some of these indices? Well, if you see high turnover and a low weighted average market cap, that is almost that will always translate into high transaction costs. So these are these very strong correlates of transaction costs, and that's what you should be paying attention to.
And Vitaly, as index strategies get more and more complex in design, usually this also results in much lower capacity. And that's one thing we would also highly recommend for investors is, when evaluating these type of strategies, is to go ask, their chosen implementer or asset manager what their expectations are of the capacity for these type of strategies.
I totally agree. And especially as implementers will have experience training these strategies, and they will also see how crowded these strategies are, and what amounts of AUM the strategies attract. So they will be much better positioned to give very precise estimates of the price impact expected with some of the strategies. So now let's move to the issues of transparency. And again, before we jump into transparency, I want to reiterate on some of that research that I mentioned earlier, showing the gap between the time-weighted and dollar-weighted return. So multiple research studies have documented that buy and hold return, here it's in green, is about 200 basis points larger than investor outcome, which is the dollar-weighted return here in blue. And this return gap is actually quite natural. It's a logical outcome of the active management structure, of the active management way of fund selection. Why? Because when you're selecting active funds, you don't know ex ante which managers have skill and which managers don't have skill. And so the only way to estimate if a manager has skill is to look at the manager's past performance. So if a manager is underperforming, you conclude from that manager doesn't have skill. You fire the manager, you look for the manager who recently had decent performance, and you hire this manager. So very logical. That's what a lot of investors do. Now, it has a very serious problem. And the problem is when fund underperforms, this fund has cheaper assets now. And when fund outperforms, it has more expensive assets now. And unlike what investors would want to think, actually, manager skill is often very, very noisy and tiny compared to these strong tidal forces of style performances. And so as a result of this natural dynamic, what investors end up doing is rotating from recently cheap and recently underperforming funds into recently expensive outperforming funds. And as a result, they produce this vicious cycle of losing about 100 basis points per annum. So how can investors close that gap? Well, actually, the smart beta factor investing strategies can help investors close that gap because they're transparent and investors know from the beginning that they're not looking for some elusive skill. They know exactly why the strategy is outperforming, and they should be expecting that this strategy is not going to outperform all the time. And if a strategy has been underperforming, well, if anything, it's a reason to continue holding to the strategy because now the strategy is holding cheaper assets. And so investors should be staying longer and going forward, the expectation for return should be even larger. And so transparency is often overlooked, but it can help investors improve their long-run performance by quite a bit.
And I'll just also say, in addition to that, Vitaly, even though index strategies are meant to be more transparent by nature, some of them are actually overly complex and quite opaque. Investors really should ask themselves, if the regulator came knocking on the door and asking for a detailed explanation of the index strategy that they had allocated to, do they feel comfortable easily explaining this? And if not, then, that strategy is probably not suitable to be in an index to start with.
I agree, Joe. I think it's a very good litmus test for the degree of transparency comfortable for each specific investor. Now switching gears. We've seen from the Mark Carhart results that factor investing is extremely important. And there are a number of questions there that investors need to learn. And the first question is which factors to choose and how to define these factors. Now, obviously, there are hundreds of factors out there. Not of those factors are robust, and no one believes that they are robust. And industry has settled probably on about 5, where investors think these are probably more robust. And these factors are value, momentum, low beta and low volatility, quality, and size or small cap. And so let's go over these factors one by one. First one I want to talk about is value. Value is usually defined as price to fundamentals ratio of the companies, and it's like cheaper companies. Now, value is probably one of the earliest and one of the earliest factors and factors with the most evidence. Interestingly, in the last 10 years, for example, value has not delivered value yet. And many investors today think that value is dead. Well, we don't share the same opinion, and we'll have the next webinar where we'll show that actually 10-year underperformance is something that investors should expect from factor investing for many of these factors, and they should be prepared for taking these risks.
So, Vitaly, just thinking on the definition for value, there was recently a published article which really questioned the validity of book value, given that in this new economy, there's a much higher prevalence of intangibles on the balance sheet for these companies. the academic definition of value is using book to price. So, how would you address that when thinking about the creation of a factor strategy around value?
So, first, I think that these researchers spot on and intangibles just kind of distort the value of the firm, fundamental value of the firm when measured by price to book. But at the same time, this is just highlights one of the points where academic definition is just one of many possible definitions. Price to book, price to earnings, price to sales, price to dividends, they all tend to deliver the same value add. The portfolios resulting from these factors tend to be correlated with each other. So they're not intrinsically better than, one is not intrinsically better than the other. They have been selected by, price to book was selected by academics specifically for some idiosyncratic reasons, such as in the long history of backtest, book value is probably the most available variable, and it's cleanly defined for different industries, etc., etc. And so when implementing live portfolio, these are probably not the relevant considerations, each factor beyond just intangibles has its own drawbacks. So, for example, price to book can pick up stocks with potentially high distress risk, junk companies. Price to earnings has its own drawbacks. It can pick up companies at cyclical peaks and troughs. The price to sales tend to pick up companies with thinner margins. Price to dividends tend to ignore growth companies which are not paying dividends. And so all of these definitions have their drawbacks. So our approach, or our suggested approach, is to combine a number of these factors, a number of these definitions, because they essentially remove, by combining, you diversify away these idiosyncratic drawbacks, and you result in a more robust definition of value. So the next one, moving forward, low volatility or low beta effect. This factor is picking companies with lower historical volatility or lower beta. And as a result, going forward, many of these companies tend to have reduced volatility too. So that's a good way to reduce overall absolute risk of your portfolio. Now, the strong caveat here is the outperformance relative to the market. The evidence for that outperformance is actually not there. And that's what investors should be cognizant of, that most of the benefits from low beta effects come from risk reduction, not from superior performance.
And we've probably seen that quite a lot when speaking to investors today, is that, over the last 10 or so years, you've seen, low volatility strategies really deliver outperformance compared to the market. But I think it's important, and investors maybe have forgotten about this, but in the 90s, low volatility underperformed the market for roughly 10 years.
Absolutely. And before 2000s, low vol companies, low beta companies had quite a bit value exposure. And so valueness has contributed in those periods quite a bit to its performance. And more recently, in the last 10, 15 years, low volatility companies migrated from being cheap, from trading about 20% discount to the market, to trading at a slight premium, 5-10% premium over the market. So today, low vol companies are more expensive, they're growthy. Now, this transition from cheap to expensive contributed to the performance of the low vol strategies, but counting on that performance going forward is unfounded, and or counting on that part of value premium from the early ages is also unfounded. So investors would be quite well prepared if they were expecting actually similar to market performance, slightly negative alpha from low vol strategies, and assume that most of the benefit they're getting from risk reduction. Now, next factor is momentum. Momentum benefits from trend continuation, so it picks up recent winners, sells recent losers, and momentum is the strategy that kind of complements some of the other strategies like value, which which are more counting on mean reversion. Now, the big drawdown with momentum is high turnover. So what it means is momentum implementation implies high transaction costs, and momentum tend to have momentum crashes.
And Vitaly, when speaking with investors, they definitely get that, value is a recognized factor in investment style, and you achieve that by buying the cheaper companies. And they also recognize that momentum is, a reliable premium or factor premium. And you really get that by chasing those companies that have done recently well. I think where a lot of the confusion comes in is how do these two fit side by side in one portfolio?
Well, they actually good complements to each other. So value, as I mentioned a little in just a second ago, value benefits from longer term mean reversion on 2, 3, 5 year horizon, and momentum is benefiting from short term trend continuation on about a year horizon. And so by introducing momentum together with your value portfolio, with your value signal, essentially value signal when the stock price is falling, value is saying buy, buy, buy. And momentum is saying hold on a little bit. That stock is more likely to continue falling, so don't try to catch that falling knife yet. And on the other side, when a recently valued company starts outperforming and starts migrating into growth, value signal will tell you, oh, this stock is not attractive anymore. Let's get rid of it. And momentum signal will be at that moment telling you, hold off a little bit, let it trend a little bit because we know that there is a trend in prices, so don't sell it yet. And by the way, so that overall dynamic improves the return of the portfolio, and furthermore, momentum is high turnover strategy, so implementing it may imply high transaction costs. Well, when combine the two signals, you don't necessarily get higher transaction costs because you're not incurring extra turnover. You're just maybe delaying some of the turnover implied by one or the other signal. Now, the last two factors are quality and small cap, and that's where probably investors should be paying the most attention, and that's where we see quite a bit of troubles. So recently, Jason Su and Enkin Kosa and I have written an article titled "What is Quality?" And there we explore what is actually quality. And what we find is quality is not an academic factor. Quality corresponds to a number of heterogeneous signals roughly related to financial health of a company. And then furthermore, many of the variables frequently used in quality definitions by many index providers, such as leverage, such as earnings growth or earnings stability, are not associated with a premium. So multiple definitions create potential for data mining, so you should be careful what goes into the portfolio. But more robust definitions of quality include the accounting quality, the conservative issuance. So these are the two variables with documented premium and with some academic exploration. And then finally, high profitability and conservative issuance, these two definitions have probably the most evidence and the strongest premium. So when defined as profitability and conservative investment, in our opinion, that is the way to go around quality. And then size. So size is, again, one of the earlier factors, and at the same time, it's one of the also more problematic factors. It comes with high risk. It comes, the evidence for it outside of the United States is rather weak. And even in the backtests, a lot of the premium is coming from what is known as delistering return bias. And then finally, small cap can be thought of as a poor man's version of value, where it's picking up on valuation component of the company coming through the market cap, coming through the prices. So based on this, just overall, just looking at small cap stocks is not the best way to earn a premium. Now, what we also observe is that many small companies are less followed by analysts, and they tend to be risky. they tend to be more risky than large cap stocks. And so what that means is that value, low volatility, momentum, and quality premium are actually empirically significantly stronger among smaller companies. And so what it means is that small cap is much better suited for harvesting this other premium rather than to be implemented on its own.
Thank you very much for that, Vitaly. Unfortunately, we are out of time for this webinar today, so we're not going to be able to get to any questions. For everyone who submitted questions today, we'll take them away, we'll have a read through, answer them, and we'll get back to you offline. Please join us next month for the second webinar in the series. For today's webinar, a replay of this will be available on our website. If you are part of the mailing list, you'll get a notification when this is available. For those of you, again, who would like to become part of our mailing list, please subscribe on our website, researchaffiliates.com, or via LinkedIn or Twitter. You can follow us. Thanks very much to everyone who's joined us and spending your valuable time with us. Before you go, we always appreciate feedback, and we have a quick 1-minute survey that will appear on your screen. We hope you can spend some time just giving us your impressions of today's webinar and how we can make these more useful for you going forward into the future. Thanks again, and thanks for being with us today.